Hello, everybody. Ben Hart here. It's 4:14. Just gonna wait 1 minute and then we'll get going. I am by myself today, but certainly a beautiful sunset here happening behind me. Nice day in Ottawa. Hope everyone's doing well. Okay, looks like it's 4:15. So I'll get going. I did a little bit longer slideshow today because I'm by myself, so there'll be a bunch of things I want to go through and cover. As most of you know, it was Thanksgiving in the U.S. yesterday, so U.S. stock market was closed yesterday. Pretty quiet trading week. The New York Stock Exchange closed at 1 o'clock today as well. Bond market was closed today and yesterday in both Canada and the U.S. So certainly from a market perspective, not a ton happened there. NVIDIA had their earnings, I guess, on Wednesday night, which was a little bit better than expected. The stock opened up a little bit and then actually closed down here on the day, something around 1.5%. So some concerns about supply chain, things like that, had a bit of an impact there. Amazon looked to be acquiring iRobot, which is those vacuum cleaners, those digital vacuum cleaners. Looks like they might get approval for that, as the stock iRobot was up 40% on that news. So still a few things happening into a shortened week. So let me just jump into the presentation here, and we can go through what I see and how things have played out so far this week in a big picture perspective. Right. Okay, I think everyone should be able to see that now. So this is a snapshot of a bit what's happened with some of the U.S. news that's come out in November so far. So lots going on this month. I'd say September, October weren't great months, certainly from a direction of markets and yields, but November started off to be a different month. But if we look at the economic data, lots of things are worth paying attention to. If we look at the red box over here, it really kind of shows the breakdown. October data released last week of October. So Philly Fed was worse than expected. So that's the services sector. Richmond services worse than expected. Kansas City, Dallas, Chicago, and the Conference Board Confidence Index was a miss as well. Then as we come into November, ADP, which is employment, was a miss. Manufacturing, auto sales. And then on Thursday, initial claims, continuing claims was higher than expected. NFP, ISM, consumer confidence, so on and so forth. As we go kind of through the whole month here, you can see the snapshot is there's a lot of misses, essentially saying that things have gotten a little bit tighter and continue to get tighter as we see GDP and inflation slow a little bit faster than expected and unemployment rise faster than expected. So I thought this was a great visual to see what's happened so far this month from a U.S. economic data perspective. Canadians quite similar as well. Lots of questions continue around what's going on with housing. So always a great chart to put up what's happened with the housing market. And so if we look across Canada, 3-month change in housing prices, as you see there, the bar on the left-hand side shows that it was a deceleration for prices. Makes sense. We see inventories kicking up, rates continue to stay elevated. But if we look at the breakdown across the different cities, if you look here, certainly Hamilton, Kitchener-Waterloo, Toronto, those had the biggest drawdowns over the past 3 months. Ottawa has slight uptick, as you know, probably looking at this chart, and so it looks like the majority of the pressure is in the Toronto and surrounding areas. The longer rates stay here, the longer that pressure is applied. So certainly worth paying attention to, as this has an impact on the economy slowing. Another great chart just around just consumption and what's happening right now. And so as rates have been elevated, everyone's costs and payments have gone up, not necessarily from an inflation perspective, but more from the fact that rates have risen. And so this is a snapshot of beer and wine sales in Canada. So first time in quite some time where we've had 5 months in a row where we've seen a decline. And then if you ask me, is it because people are going another direction, cannabis, something like that? Again, you're seeing negative month over month for the last 5 months. So consumers pressured right now. So consumption is slowing across all things we consume. One of the ways I think I've been looking at the last couple of years is just around what's going on with liquidity, and this is GMI, which some of you know I follow, which is Raoul Pal's research firm. And so Raoul puts out every Sunday puts out some charts that he sees, and one of the charts that I think is extremely important is this white line, which is global liquidity. And when I say global liquidity, it means is there more money in the system or less money in the system? And so, and that would be across bank accounts, central banks, every kind of bit of dollar in the system. And so, as we saw liquidity start to bottom here last year, we're starting to see it tick up here. And GMI has this, we'll say, lead index. They tends to lead by 7 months. And so this is a view that they expect global liquidity to increase. And what does that mean? That means kind of some of the things I've been saying, which is I think interest rates have gotten too high. Quantitative tightening has probably gotten a little bit too tight as well. And so if this plays out as my view is we think rates come down, I think liquidity starts to come back in as the central banks start to provide some support. And that would be globally. But most of this is the global data, so that'd be globally. But I certainly expect it to happen in Canada as well as the U.S. Actually, Bank of Canada, they pulled back at a much faster rate and reduced their balance sheet by about 50% in the past year, which is much faster than the U.S. central bank. So this kind of falls in line with it. This great chart from Jim Bianco. The trend of flows changed when the Fed started hiking. So the Fed started hiking rates here, if we remember, a year and a bit ago. And so as money started to flow where it went instead of where it was going before, which was a combination of money market or high interest and ETFs, we saw that kind of peak here just shortly after they started hiking. And then we had this crossover point about a year ago now, effectively. And we've seen money pile into money market funds and out of ETFs over that period of time. So as that global liquidity starts to come back in the system, I'd expect you actually see this start to toggle towards here. Certainly, as interest rates get cut and the real tight economy starts to bite, you'd expect that you'd see money start to flow in the other direction. So as we look around the world, lots of discussion around what's going to happen with oil and gas. I certainly have lots of conversations with clients about this and EV sales. So spend time looking at this and who's buying and what's buying. I thought those are great side by side, a couple of images to think about what it potentially means here. And so if we look at on the left-hand side here, you see where's the largest demand for oil take place. And so you see road transport, it's about 44% of overall consumption, petrochemicals, shipping and airplanes, building power, and then other buckets. And then if we fast forward over here to the right-hand side, North America lags global sales of EV. Certainly, if you look at electric vehicles in China, for example, they've been selling extremely fast relative to North America. And so, as you look at where the energy is in the world, certainly North America has a big line share of that. And so it would make sense that they would tilt more quickly towards it. But I think these will be two important dynamics. I don't think that we're going all one way or all the other way, which some people tend to think. But these dynamics playing together will have an impact on future prices. So certainly worth watching and paying attention to. So I have one more slide here, and sometimes it's important just to look back and overlay. And so this is if we can see this chart, this orangey kind of yellow line is the share price of Amazon from 99 until where we are today, effectively. And then, the white one is that, and then the yellow one is Coinbase. And so when we kind of think about technology and companies and how they fit and how they track, Certainly it's worth paying attention to occasionally and saying, what's the likely trajectory given where we are today? And so it's a reminder that, when you get a massive consolidation, which we've had in some of these companies like Coinbase, for example, you'd expect that we would consolidate like this, and then you have the potential for a big run. They certainly continue to be the leader in the space for settling Bitcoin and Ethereum. They've complied with all securities regulations. They tend to be the ones the ETF providers are going to use as well. Coinbase had a good run here the last couple of weeks, but I think this is a good way sometimes to strip it back and say, is there more potential, or is the run over from here? I thought this was a great visual in order for us to think about that. And I realized that I didn't put those charts up. You were just listening to me talk, and so I'll send those charts along when we summarize the video here. I'll just show you this last Amazon chart before. Let's see if it can come up. I don't know if everyone can see this chart here, but this was the Amazon chart I was discussing. So Coinbase is the yellow one, Amazon's the white one, and so this is certainly something worth paying attention to here. And so it looks like I'm back here. So as we start to think about what's ahead here, spending time thinking about what's going on from a market perspective, looking at where we go from here. We've had a good move in interest rates a little bit lower in the past 3 weeks, and we'll see if that continues. But most of the data continues to show me that GDP is slowing and slowing faster than expected. And in some parts of the world, like Europe, for example, they're already showing recessionary data. And so yields have come down. And I guess the magnitude of which and how fast they come will be something I'll be paying attention to. But a lot of things are pointing towards the fact we're in kind of that recessionary period. Liquidity is probably going to come back. What's the market going to do between now and that happening, which is probably March or April next year? Certainly that's what I'd be watching for and paying attention to. Do you have any questions about taxes and tax planning and gain losses? Certainly feel free to shoot me a note. We could have a quick meeting going through that with clients as we wrap into the end of the year here. And as always, if you have any questions, shoot me an email, give me a call, or send me a text. And thanks very much for joining, and have a great weekend, everybody.